You are absolutely not going to believe the sheer technical wizardry we just witnessed in the New York session overnight. We are talking about a record-breaking surge that has completely flipped the script for every single portfolio manager in the city. G'day Gain Squad! Let's see where the smart money is flowing today on this high-stakes Friday, April 24th. We are deep diving into the S&P 500's massive April recovery and how the Magnificent Seven are totally outclassing gold. Then we'll be crunching the data on gold's recent breakdown to see if we can finally optimize this entry for the long haul. Just a quick heads up traders, I am not a financial advisor, so please do your own due diligence before scaling into positions. The big question is, has the tech rally reached its peak, or are we just warming up for a 7,500 level? Drop a comment with your target, smash that like button, and subscribe to Goldie Gains to stay ahead of the curve, gold getters. Let's look at the S&P 500 story, because this April recovery has been nothing short of a ripper for the bulls. After a bloody difficult March where the index fell 8% due to war jitters, the rebound has been absolute fire. On Wednesday, April 22nd, the S&P 500 officially set a fresh all-time record high of $7,137.90. The market's having a bit of a wobbler with the energy sector, but the broader index is holding on to these spectacular gains. Investors are totally shrugging off the geopolitical noise and focusing on a massive unwind of the risk premium we saw last month. It is like the risk-on machine was throttled to its loudest setting of 2026 as we cleared every major resistance level. Analysts reckon the benchmark blowing through 7,000 is a signal that liquidity is finally flowing back into equity growth. We've seen the index gain over 1.8% this year already, which is a solid effort considering the rocky start. On Thursday, April 23rd, the momentum slowed slightly, but the structural uptrend remains as clean as a whistle. Options pricing is showing a clear upside skew, meaning the big players are paying more to bet on a further rally. We are seeing a rare gap-up event that history tells us usually leads to even more green candles in the following weeks. The market sentiment has shifted from fear of conflict to fear of missing out in less than a fortnight of trading. Even with inflation sitting above the 2% target, the earnings power of these US companies is keeping the index buoyant. It is a proper V-shaped recovery that has left the bears feeling a bit flat out and looking for a place to hide. If the index holds above 7,050, we could be looking at a very legendary finish to the second quarter. Now, let's talk about the heavy hitters, because the Magnificent Seven are basically carrying the entire market on their backs. While gold is struggling to find its footing, the tech titans are putting on a clinic in capital appreciation this week. Apple stock surged over 2.6% on April 22nd to hit $273.17. Nvidia is also doing the heavy lifting, up 1.3% to settle at $202.50. Microsoft joined the party too, climbing over 2% to reach $432.92. Even Alphabet saw a massive 2% jump, taking the share price to $339.32. Amazon is looking healthy at $255.36 after a 2.18% rally. Meta Platforms had a bit of a slower day on Thursday, but is still holding strong at $674.72. Tesla is the outlier, only gaining 0.28% to hit $387.51. The Mag 7 now make up nearly 34% of the entire S&P 500, which is a massive concentration of power. Investors are piling into these names because they are armed with enormous cash reserves to dominate the artificial intelligence race. We are seeing a reality phase in tech where people want to see actual returns on all that AI infrastructure spending. Nvidia is still the shovels provider of this digital gold rush, and the demand for their chips is described as insane. Microsoft is facing a capacity crunch in its cloud division, but the market is looking past it toward future scaling potential. When you compare these moves to gold, it is clear that the smart money is currently favouring tech over traditional safe havens. Gold has actually lost ground against the S&P 500 this month, making stocks look more attractive in real terms. The S&P 500 to gold ratio is currently sitting at 1.48, proving equities have the upper hand. But wait, because the gold market is currently telling us a very different story about the global financial plumbing. Gold has been trapped in a consolidation range between $4,670 and $4,875. On Tuesday, April 21st, gold triggered a bearish rising wedge breakdown when it slipped below $4,737. This move was a proper reality check for the gold getters who were hoping for a moon mission above 5,000. The price action suggests that capital moved into the US dollar rather than bullion, despite the ongoing uncertainty in the Middle East. Gold fell over 2% on Wednesday to settle near $4,712 per ounce. We are seeing a war trade paradox where geopolitical risks are actually strengthening the dollar and hurting the yellow metal. Ray Dalio is warning everyone that the 65% jump in gold last year was a signal of fiat currency debasement. He reckons you should have at least 15% of your portfolio in gold as an investment necessity right now. Peter Schiff is even more bullish, predicting gold could hit $6,000 if the US debt bubble finally pops. Goldman Sachs is holding firm with their target of $5,400, citing massive central bank buying. Emerging market banks are apparently snapping up 60 tons of gold every month to diversify away from the US dollar. So, even though the short-term price action is a bit messy, the long-term structural case for gold remains golden. The market's having a bit of a wobbler because it is trying to price in both high-tech growth and high inflation risks. If the peace talks in the Middle East fall through, gold could easily snap back and retest its all-time highs very quickly. But for today, we need to look at the intraday levels to see where the next big move is going to trigger. Let's dive into the detailed technical analysis for gold because we are at a proper crossroads on the charts. On the daily timeframe, the overall trend for gold has shifted to bearish following that wedge breakdown on Tuesday. The 14-day relative strength index is currently hovering around 42.45, which is leaning toward a sell. We aren't in oversold territory yet, which means there could be more room for the price to slide before finding a floor. The 50-day moving average at 4,869 is now acting as a major dynamic resistance level. Every time the price tries to rally, it gets rejected by this 50-day average, which is a bit of a worry for bulls. On the support side, the $4,700 level is the psychological floor that bulls are defending fiercely. If we get a decisive hourly close below 4,700, the next stop could be 4,601. The 1-hour chart is showing a bullish RSI divergence, which suggests that the downward momentum might be losing steam. This is a proper golden entry if we can clear the intraday resistance at $4,750. Looking at the Bollinger Bands, volatility has expanded after a squeeze, confirming that a breakout move is currently in progress. If we stay above the midband near 4,735, the bias remains neutral to slightly bullish for the week. However, the 100-day and 200-day moving averages are still pointing toward further selling pressure in the short term. Traders should watch the high of 4,772 recorded on Wednesday as the first sign of strength. A rally above that level would signal that the bearish wedge breakdown has failed and the uptrend is resuming. But if we break 4,640, the case for a deeper correction toward 4,400 gets stronger. The US dollar index, or DXY, is currently at 98.70, which is putting heaps of pressure on gold prices. A stronger dollar makes gold more expensive for everyone else, so we need to see that DXY pull back for gold to shine. We are also seeing a death cross formation on some of the smaller timeframes, which is keeping the day traders very cautious. Let's see what the tech charts are saying, because Microsoft and Apple are looking absolutely unstoppable right now. Microsoft's 14-day RSI is sitting at 71.08, which is getting into overbought territory. All their moving averages from 5-day to 200-day are in a strong buy configuration, showing incredible momentum. Apple is in a similar boat, with an RSI of 60.87 and a strong buy technical rating across the board. It is trading well above its 200-day moving average of $256, which is a massive show of strength. Nvidia has a slightly more neutral RSI of 46.83, suggesting it is consolidating before its next big leg up. Tesla's technicals are the weakest of the bunch, with a strong sell rating on oscillators and an RSI of 46.2. The market's having a bit of a wobbler with Tesla, as it tries to figure out its margins in the face of global competition. But overall, the Magnificent 7 tech technicals are far superior to the current bearish setup we see in the gold market. It seems like the market is rewarding companies with real earnings growth over non-yielding assets like precious metals today. However, the gold-to-oil ratio is sitting at 53, which historically signals that a stock market correction could be looming. 1 ounce of gold currently buys 53 barrels of crude oil, a level that often precedes a spike in market volatility. So, smart money, don't get too complacent with the tech rally just because the charts look pretty right now. Famous investor Jim Rickards thinks the new BRICS currency project is going to force a massive gold reset by next year. This digital currency, known as the unit, is allegedly 40% backed by physical gold reserves. If that happens, it would create a massive structural demand for gold that would bypass the US dollar entirely. The BRICS nations already control about 50% of the world's gold production, which is a serious leverage play. Russia and China are leading this charge, hoarding bullion at rates we haven't seen in the modern financial era. Even with the US dollar index at 98.7, the de-dollarization trend is a slow burn tailwind for gold. It means that the floor for gold prices is likely much higher than it was in previous cycles due to central bank demand. On the local front, the Aussie dollar pair is trading around 0.72, which is helping the Aussie gold price stay up. In local terms, gold is trading at 6,573 Australian dollars per ounce, which is down slightly. Aussie mining stocks like Regis Resources are swimming in cash, showing that the high gold price is good for the local economy. Regis Resources actually has over $1 billion in cash on their balance sheet right now, which is a massive result. It shows that even if the gold price dips a bit, the producers are still printing money at these elevated levels. For the Sydney traders, this means there is still plenty of opportunity in the materials sector of the ASX 200. The ASX 200 fell 1.18% on Wednesday, but it has shown heaps of resilience this year. It has gained about 2.7% so far in 2026, outperforming the S&P 500 in the short term. This is mostly because our local market is so heavily weighted toward big banks and massive mining companies. Looking ahead to the next session, we have two very clear scenarios for the gold getters to keep an eye on. Bullish scenario: gold clears $4,750 and heads back toward the psychological 5,000 mark. Bearish scenario: the dollar keeps climbing and we break 4,700, opening a trapdoor to 4,600. The weekly outlook suggests an average price around $4,787 if support holds firm. We also need to watch the West Texas Intermediate oil price, which just jumped up to $96.54. Higher oil usually means higher inflation, which is gold's favourite environment to shine in over the long run. But in the short term, the market is treating high energy costs as a reason to keep interest rates higher for longer. This is why gold is behaving so strangely right now. It is caught between being an inflation hedge and a high-rate victim. Where do you think the smart money is moving to for the rest of 2026? I reckon we are going to see more volatility, with sophisticated investors using the tech gains to fund their gold accumulation. To recap, the S&P 500 just hit a massive record high of $7,137 on Wednesday. The Magnificent Seven are leading the charge, with Apple and Microsoft looking like absolute beasts on the technical chart. Gold is currently having a bit of a wobbler after a technical breakdown, but it is trying to stabilize at 4,700. Technical indicators like the RSI and moving averages are screaming sell for gold, but the smart money is still hoarding. Geopolitics and the de-dollarization roadmap from the BRICS nations are providing a solid, long-term floor for precious metals. Oil prices are spiking again, which could be the catalyst gold needs to finally break out of this consolidation box. For now, the equity market is the king, but the underlying risks to the US dollar are growing larger by the day. So, what is your move next week? Are you taking profits on the Mag 7 rally, or is this a proper golden entry for you? Let me know in the comments if you reckon the S&P 500 can actually reach 7,500 by June. Smash that like button if you found this breakdown helpful, and subscribe to Goldie Gains for more daily alpha. Keep your positions tight and gains golden. I'll see you at the next close. Cheers.